you got to remember the law of the farm. You cannot sow something today and reap tomorrow. A seed has to go through various seasons before it turns into a fully blown tree. So is the case with investments.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
So, first off, like Richard said, thank you very much, Rajiv Bhai, Prabha. I think this is a fantastic opportunity for as a platform for budding investors. I think while Richard spoke about specific concept of investing, I think I want to touch in general about what investing is, what it means to me, and what it should actually mean to people. Somewhere around 2012, a person that I revered very close to me is pretty much the person responsible to kind of give me the concept of investing, and handed me this book. And obviously, reading it back then and reading it now after so many years, I just realized that when something is very clearly mentioned, clearly defined, it can mean something different every time you read it. So this book went on to becoming some sort of a Bible to me. And what I thought, when Parag Bhai asked me, I said that first things first, I think people need to kind of demystify a lot of stuff about investing that actually exists. So before I actually got into investing in 2012, I was a third generation broker and lived life between the buy and sell boards. And I always thought that life and success was measured by 3:30 p.m. how much you take in your bag and stuff. But anyways, this was the book that actually changed a lot of those theories. Now, I think the essence of this book essentially is trying to read into the mindset of successful investors. And if you notice, there are two faces on that. One obviously is Warren Buffett, the other one is George Soros. For a greater portion of people that I know, they don't revere George Soros as an investor, and rather treat him as a trader. But actually, as we will go on to see in the book, there seems to be a common trait of habits that form between successful investors. Their theories of investment might be different, where they find their value might be different, but essentially certain key characteristics remain to be the same. But before we enter into that, let's just take a step back and kind of figure out what is it that we are actually miscuing, what are we misreading. So, as defined by Mark Titus, the author of the book, he says that there are 7 deadly investment sins that you must absolutely stay away from. If you believe them, unbelieve them. If you have them, wipe them off, and then go back. So, I'm just going to read it real quick. Since you have to predict the market's next big move to make big returns. But when this study was conducted across all these quote-unquote successful investors, their ability to predict the market is no different from like you and I, and they probably don't even think about predicting the market. The guru belief, it says if I can't predict the market, someone else somewhere can, and all I need to do is find him. Again, if someone actually is able to do that, do you really think he's going to kind of go out making fan following, or he's just going to open a brokerage account and start raking in the money? Inside information is the way to make really big money. I was at one of these seminars with Ramdev Agarwal, and he was telling me that one of the biggest mistakes he made in his life was sold HDFC Bank because he had an insider. And that was like the biggest disaster of his life. Diversifying. Now, according to Warren Buffett, diversifying is your insurance against ignorance. So, as we'll go on to see in some of the other habits, they've given very concrete examples as to why you shouldn't diversify. And if you have an idea which you're fully researched and you're convinced in, you just go all in for the kill. You have to take big risks to make big profits. I guarantee you the people who've actually made money have been more focused on avoiding risk rather than taking big risks. Okay, so, if there is a risk, you'll probably see them going south from the opportunity. Again, the system belief, there exists some arcane refinement of technical analysis, fundamental analysis, automated trading, gang, astrology that guarantees profits. So again, like if that was the case, really, I mean, wouldn't we all kind of be $1 billion, be holding ATMs all over the world, with 60,000 people attending and so on and so forth? You know what the future will bring, and being certain that the markets must inevitably prove you right. Now, this is quite critical, because this goes out to explain, the theory of no knowledge versus half knowledge. So some people, kind of go half learned or half studied, go in, take up all, and are almost convinced that whatever it is that I do, eventually has to follow through. Doesn't work that way. Anyways, so basically when we go and study these minds, Buffett and Soros, and what the common indicator between the two of them is that, they both share the same beliefs about the nature of the markets.
Can I ask a question?
Sure.
Can you go back one?
Absolutely.
Between 4 and 7.
Yeah.
Isn't 4 helping you to ensure that if 7 happens, you have something to fall back on?
So absolutely, the point is, what 4 is telling you that inadvertently we're all going to die, which is why we buy insurance. So with diversifying, you are saying inadvertently I'm going to make a loss, so I might as well kind of spread it across. But what 7 is telling you is that sometimes just because someone tells you that, for example, like he said, there are these FMCG stocks which are like doing 60, 70, 80 times multiples. But technically, what that is the number of years it's going to take you to get your earnings back, right? So if a stock is trading 80 times earnings, it means I have to wait for 80 years till that earnings come back to me. Going in at such a high PE and saying, no, eventually it's a good stock, it's a good management, everything is great and I must make money. The people who invested in Infosys at, in the .com bubble just got relieved now, recently in the last 1 year. So that's how these two are different. Investment is not focused on profits they expect to make. Indeed, they're not investing for the money. What actually drives, and there's another book called Tap Dancing to Work, which talks about Warren Buffett's mindset. Says that if Warren Buffett was really investing for money, or George Soros was actually investing for money, they would have, by the time, before they started their relative, partnerships like the Quantum Fund or, Berkshire Hathaway, they already worth like 25, 30, 40 million dollars back in the 60s and 70s. They would have retired then. But the idea that they keep doing the same thing means that they are essentially in love with the process and not in love with the money or their investment, so on and so forth. Both are more focused on not losing money than on making it. They never diversify. They always buy as much of it as an investment as they can get their hands on. So, if you ever ask either one of these guys, and when I say these two, I mean the general public. What is your theory of allocation? Or what is, how much should I allocate in each stock? They'll just tell you that I go all in the minute I find an investment opportunity. So even they don't know actually how their portfolio is structured. Okay, it really depends at that point what is the expectancy of the profit of, as in where they see the company going in the future and how much money I have in my bank. So the concept of allocation does not exist. Their ability to make predictions about the market or the economy has absolutely nothing to do with their success. As we go on into the happens to happen. Now there are actually 23 apples, but for want of constraint of time, we might just kind of breeze past some, but we'll really focus on the key ones. Preservation of capital is priority number 1. So the master investor believes his first priority is always preservation of capital, which is the cornerstone of his investment strategy, and the losing investor, only investments aim to make a lot of money, as results often fail to keep it. Now, we just take a step back and figure out where Warren Buffett and George Soros comes from. George Soros, unfortunately or fortunately, I don't know, is a victim of, the ethnic cleansing of the Jews. So, while he stemmed from a very, successful family back in Budapest, he actually had to kind of go under for 4-5 years during Hitler's tyranny. And the key focus of his life became survival, right? So when a person has actually seen that, he knows that, yesterday I was a millionaire, today I'm actually fighting for my life. So that became the cornerstone of that became the foundation of his theory of investing, saying I was survive first, I will learn later. And B, once I learned it, I never want to lose it. Right? The same way Warren Buffett actually was the son of Howard Buffett, who was working for a bank, and all of a sudden, the bank went belly up, and his dad was left without a job. And so he started a small securities firm, but this was through the Great Depression, which was a very trying time in the United States. So the basic foundation of these two and probably many other investors are that I do not want to lose money. So rule number one, don't lose money. And rule number two, don't forget rule number one is what Buffett says. George Soros says, survive today, earn tomorrow. Now this leads into a very common behavior. When an average investor takes a position, what is he looking at? His odds of profit and loss are like 50-50, so it's more like a coin toss. Whereas when the master investor makes an investment, he focuses more on the fact that I cannot lose money. Right? That's why the concept of margin of safety comes in. Margin of safety in the sense, if I'm buying any company whose market cap is as good as the real estate he owns, so on and so forth. So there can be many measures which you have to devise for yourself. Their focus essentially is not how much he can earn, but the point that he doesn't want to lose any part of it. So as a result of that, they passionately avoid risk. By passionately avoiding risk, what they're doing is that they're making sure that at no point do I have to go into the battlefield, with a knife. Might as well just move away from something that I don't understand or I'm not comfortable with. Every investor must actually devise his own unique investment philosophy. Now, between the two, Warren Buffett and George Soros, there is a common theory of the market that says that the market is flawed. Okay? Warren Buffett says that the market, the stock market that we go to, essentially is Mr. Market as devised by Benjamin Graham, who comes to you every day with a quote. So I'm going to the market and I see all these quotes. I might either buy something or sell something or take my interest away. But he's saying don't use the market as a guide. Use him as a trader who's coming to sell you something every day. And what Soros says is that broadly, because of the elasticity of our mind or the common people's mind, events tend to go with high reflexivity. So if something is good, it will continue to go extremely well. If something is bad, it will go extremely bad. So he bets on the euphoria to devise something called the boom and bust cycle. So both of them actually identify the market reality first. Go to the market and say, whatever it is that you're offering me, do I want it? Do I not want it? Do you want my stake or do I want your stake? Buffett says, Soros says that at the end of the day, if there is inertia in people's thoughts, then actually that is going to drive markets to two completely different extremes. And you decide at which point you want to get in, which is his theory of applied reflexivity. So once you have actually devised the fact or agreed to the fact that the market is actually irrational or the market is not in equilibrium, then the smart investor will actually devise his set of criteria. What will he buy? When will he buy? What price they will pay? How to buy? How much to buy? Monitoring the progress of the market. So once I've got it, I will constantly keep watching my position. I will keep watching that particular investment for any further developments. More importantly, both of them have pre-decided when they want to exit that investment. So for Buffett, it's either when that investment that is made ceases to match his criteria, and for Soros, it is when equilibrium sets in. Now here I just want to make a point. When Buffett started out, he was a hardcore believer in Benjamin Graham's theories that the market is flawed, and hence he would get in at a point of margin of safety where he would typically buy $1 for 25 cents. But when it reached $1, he would sell it. But at that time, when he was learning his theories, there was another, like Buffett, like Graham is called the father of value investing. There was another budding investor called Philip Fisher who was coming up, who eventually came on to be known as the father of growth investing. What we saw over time was, as experience led Buffett to make investments and kind of get in and out of investments, he started devising a little bit of both. So the key thing to point over here is that master investors will never conform to a particular set of belief. They might go out to devise their own sets of belief. Now this is actually quite interesting. One of the reasons why they say that you shouldn't diversify is as good as going to Bill Gates and saying that, boss, now that you've actually developed Windows, you have all your eggs in one basket, please start a utility company tomorrow. You know, or it's like, telling Pavarotti, which is a very famous opera singer, that, boss, enough of opera, you can sing, we know, that's great, but from tomorrow please do rock, because otherwise you're not diversified, right? You might be in big problems. So the master investor believes that diversification is for the birds, in the sense people who essentially are not very confident of their investment and might have the fear of risk are the ones who actually diversify. But the master investor has obviously no fear of risk because they avoid risk like the plague, and that we've established before. I don't want to take risk. If it doesn't match my criteria, I'm not going for that investment. Hence, when the opportunity arises, they go all in. In the book, they actually mentioned at one point that Warren Buffett is more stressed when he has more investment opportunity than the money in the bank. And that is what actually gives him stress. That, okay, there's so many opportunities, how do I capture all of them? Which actually talks about another point also called leverage. Now, a lot of people are actually under the belief that Warren Buffett doesn't use leverage, which is actually completely wrong. Because the biggest leverage that Warren Buffett uses is the float that actually comes from the insurance company. Right? We all know that Warren Buffett owns an insurance company which keeps throwing out, premium money to him, which is due at a certain point in the future. Now that point in the future, when the money is due, in the meantime he's actually made some very good investments and made an above average rate of return. So that is his leverage. As for Soros, the leverage is futures contracts and forward contracts. Both of them are very focused on after-tax returns. So not only both of them actually. Most of the investors that I have had, the good fortune of meeting, they always kind of focus on one thing, that if available, we don't want to pay tax. Correct? We don't want to kind of evade taxes, but where we can avoid tax, tax avoidance is not. So, in the case of Warren Buffett, essentially, what he did was, he kind of made a very simple focus that the companies that I'm going to buy, I'm never going to sell. Right? So, when will tax actually hit me? When I book that profit. So, if I'm not selling the company, obviously there's no tax due to me. And in the case of George Soros, obviously he went and started his company somewhere in these, Cayman Islands or whatnot. Both of them actually invest only in what they understand. So, in the case of Warren Buffett, I'll just quote an example here. There was a particular case back in the 60s and 70s when American Express, which was one of the largest, credit card companies, had an internal issue of one of their subsidiary businesses, which was tanking oil. And it was more of a franchise product. So one of the guys that American Express had done a contract with had filled up the tank with water, and on the top had oil, right? At this point, what happened was this whole thing broke out in the media, and American Express was hitting lower circuit. At which point this story actually interested Warren Buffett. So what he first did was he went down to, there's a steakhouse in Omaha that he goes all the time. He went there and he stood behind the cash counter. And he said that, okay, everyone who comes here is actually swiping their American Express card. So what does that tell you? It's business as usual. Okay. Now he understood that. He went in, he did his own research, and at that point he started buying the company. This is actually the first time he went against Benjamin Graham's theory. And at the same point, what Soros did was, there was a particular case when, the Germany's, before it was Germany, and they were split. And at that time, both these countries actually had different currencies. So, when the Berlin Wall was broken down, one of the political issues were, how do we match these two currencies, right? They were part of something called the snake. So the snake was what we know today as the European Union, was very similar back then to the snake, or the snake was one of the predecessors to today's European Union. The Great British Pound was also part of this snake. At that point, when East Germany and West Germany actually came together, the currency of East Germany, which was technically a worthless currency, all of a sudden got an exchange rate of 1:1 against the Deutsche Mark. And George Soros actually saw this very early. And what he did was he started predicting the unfolding of events that, if the other currencies have an issue with this, then eventually it is the Great British Pound which would kind of come out of this kind of an arrangement, because they might not be okay with the overall economics of, the common currency. And true enough, he went in, he did a lot of his ground research. He drew up like a 5-point agenda, and at every point he started increasing his stakes. So what I'm trying to tell you is that practically these guys will only move into spaces that they understand. They're not going to go out, looking for ideas from someone else, or going for tips, so on and so forth. In continuation, they will refuse to make investments that essentially don't meet their criteria. Now, in their criteria, one and the main criteria is also price. So even if I like the investment, I sent it, like he was saying right now, and I think there was a question from the back about, what do you call it? These famous FMCG companies, so on and so forth, which don't match your criteria. So these guys would actually let it go. Now, just to quote a local example for you guys, it was brought to my notice that actually Sachin Tendulkar became a legend, not by hitting every ball for 6. So if he would go on the field, it's not that, okay, I have to make the maximum runs. He just practiced one simple philosophy. Said, "Ye ball mere ko samajh mein nahi aata, I'll let it go. I'll let this go." But the ball that he did understand, he hooked for a 6. And then after that, what happened, everyone knows. This will again pin back to the same point of doing your own research, as I explained. They have infinite patience. So one of the things that these guys just don't worry about is time. Okay? According to them, a smart investment, a profit in a smart investment is booked the time you actually make that investment. So you have actually already kind of figured out the difference between the value of that and the price that you're paying, which is called the price value divergence. And the minute you execute the trade is when the profit is booked. And time is the only thing that will actually hand this profit to you. So time is something that these guys don't really bother with. They're more confident on the investments they've made, and that's what happens after that. I mean, it's just a matter of time. See, this is a very critical point, because most of the time what happens is, if an investment makes sense to us, we tend to procrastinate. I'll look at it, I'll check it out, let's figure it out, let me go to the management meeting, so on and so forth. Now the case with the master investor is that the minute they understand the idea, they're not going to wait for tomorrow. Okay? Now why is this important? According to master investors, they say that a good idea comes across to you probably once a year, if you're lucky, or maybe once in 2 years. The minute they find a winning idea, it is assumed that they have already done their work. So, for a pastime, what Warren Buffett does is he reads annual reports starting from 8, right? His only analyst, Warren Buffett's analyst, is his filing guy who actually files his annual reports. And that's his analyst. As far as George Soros is concerned, all he does is he tracks political events. So, this stems back to, before George Soros actually built his career, he actually wanted to be either a journalist or he wanted to be one of these, guys like John Maynard Keynes. So their interest was highly focused on, information, and we're assuming that by the time they actually arrive at this opportunity, they probably know much about this opportunity. Like we saw in one of the prior examples, one of the criteria is actually when to sell. Now, quite critically, that is important. So in the case of Buffett, like I said, they've already decided that he will sell the company when it doesn't match his criteria. But here, I'll make another point. One of the things that is a reason to determine the sell, and that actually Warren Buffett calls as a mistake, is liking a company and not getting enough. So you'll get your introductory quantity and the price will run up. And Warren Buffett actually calls that the $2 billion mistake. When he actually had, a sizable investment. I forget the name of the company. But what he wanted to actually invest was, let's say, 2 million shares, and he got only 700,000 shares. And as and when the price ran up, he said, this quantity is too small for me, and he sold it. Eventually, that stock that 700 million shares eventually went up to be $2 billion, which he calls the $2 billion mistake. But anyways, that is obviously not one of the reasons to sell. But they know exactly when they are going to kind of exit their investment. All these investors have typically, formulated a strategy and they actually follow it very closely. So, even tomorrow, if you get a new opportunity or, if they get a new idea, they're not just going to go at it just because it looks interesting. They're very focused on what their strategy is, what their theory is, and based on that, they will take a call. See, I think this is actually one of the most important points of this entire presentation, and they're just kind of one thing that the smart investor will actually make very common is that he is fallible, he can be wrong, and they don't really go out with the image that I'm right, I'm always right. I can't do anything on that. But the smart guys or the winning investors will essentially pick up on their mistakes, make a record of it, talk more about their mistakes than their victories, and make sure they never repeat it again. So that is, admitting to your mistake and the following slide, turning mistakes into learning experiences is actually a very integral part of the winning investor. They pay their dues. Now, what does this mean exactly? Most of these winning investors have something called an accumulated subconscious. So before they might have actually started investing, they have actually tried their hand at a lot of these varied experiences, or it may be in the stock market also, but everyone has actually done their time before they come to or conform to a particular strategy, and as is the case with both these guys. So we know a lot about Warren Buffett trying to, being a newspaper boy, he's bought and sold these Coke bottles at 25 cents and sold them. So he's actually been enterprising right from the start. But Soros, incidentally, started off with being an analyst for an English bank, and that kind of led him into a second position where he was a junior fund manager, and all these guys actually did their part of their career mistakes before they actually ended up starting their own fund. So it's very important that you pay your dues in the market before you start taking your own calls. Now this is something that the book says, and I don't essentially agree. What they're saying is that the winning investor will never really talk about his ideas or never really talk about what they do. It might hold true for Soros because he is more time sensitive. Warren Buffett is not. So what the book says essentially is that they don't want their positions to leak out for various reasons. People might front run them, or people might kind of get their position or whatnot. But I feel, in investing, when you're actually discussing ideas, you're technically learning more, you're understanding more. So, this is a point where I probably differ. They know how to delegate. So, Warren Buffett, once he buys a company, he actually keeps all the employees on board. And what is mysterious actually is once the person has actually sold his business to Warren Buffett, how the hell does he manage to keep them motivated enough to still work for him? And that's something that, we attribute to the genius of Warren Buffett. And as far as George Soros is concerned, in 1981, he actually had a point where he burned out because he was trying to do everything on his own. And at that time, it was a lesson to him that, he should actually start building up, a fund and start delegating more. Every smart investor is actually very frugal, and I think Richard also mentioned in one of his slides. What these guys do actually, and this is a very good experience, maybe we should all try it. When they actually spend money, they're not calculating the amount they spend today. They're calculating it as to what that can compound in 20 years. So they said that at one point Warren Buffett's wife went and bought furniture for $15,000. And he said that this could have, kind of compounded to $500,000 after 20 years. So his wife actually bought furniture worth $500,000. So this is the kind of a mindset that, a smart investor wants to
tell this to your wife.
Huh?
Tell this to your wife.
This is why they practice
Let us sleep.
So, but actually, this is a very important trait. If you so think of it, that capital preservation is so important that you don't want to spend, which is why you see, people, smart investors typically don't flaunt on their assets and so on and so forth. It's not about the money. Like I said, both these guys are essentially more kicked about the process that leads them to the wealth rather than the wealth itself. This is what keeps them going, and I think one of the people actually asked George Soros as to how long they see him working, or how long will he keep investing, and he says, I'll keep investing till I die. So clearly it is a process that gives him a high and not the result. Love what you do, not what you own. This is something that we typically fall for. I know I have fallen for many times. When you've given a lot of effort into any one of your investments that you've kind of studied, you tend to fall in love with the investment. Whereas the trick is that you should actually fall in love with the process that led you to that investment, rather than actually the investment. You live, breathe, and you live and breathe investing 24 hours a day. And I think once you get at a point where your passion is actually driving your career, I think this just comes subconsciously. Almost to the extent where, this might actually interest you. When I got married around 3 years ago, and I, kind of told my wife, she was trying to always figure out what is it that we do, why we sell share. So I explained to her, the best part about this is that now I know that you have a predictable pattern. So the first thing I'm going to buy is HUL, because I know you're going to hog up all the products of HUL. So I might as well buy a company, pay a company that I own. So I feel that somewhere, everyone who is kind of gets deep into the process of investing will kind of cultivate that into their life. So that's pretty much it. Anyone who names all of this in succession gets a free drink.
I can name the first guy. He's very, very popular. Good looking. If I only good looking guy on the screen.
No. So he did it as an attachment, and I thought it was great cheer. What I'm trying to do is, even though I said don't try to predict, I'm actually predicting.
The last time Parag Bhai photo,
I saw the one. I said good looking.
So, anyways, that's it from me. Any questions? Okay, glad to give a shot at it.
Since you specifically spoke about Hindustan liver, I have a client, for example, who buys only liver. Okay. So he already owns around 150,000 shares. He's bought them at the old 80,000 cost him less than a rupee, and he continues to buy 900. Now you talk about capital preservation being the most important. Now if he was your client, what would be your specific advice to him today when the valuations are at a peak and you understand it takes 60 years to recover the investment?
See, one of the things like we said on the presentation was that you need to give a lot of time to your investments, and clearly your client has done that, right? He's given a lot of time. Now, let's not forget that the market essentially, or Mr. Market as we call it, is very irrational. What we are expecting, and what I would tell my client that if he's actually moved in at a good time and his holding is great and his quantity is great, and first and foremost it's a good solid company, I would tell him to not bother too much about market gyration, because eventually, see, any stock runs mainly on its the potential to compound its earnings, right? And if the stock is doing that beautifully, it's our job as professionals, or rather, as whatever little that we know, it's our job to actually kind of keep clients away from non-quality investments. So I would typically tell him that he's done a great job. If he wants, he can sell them, which is typically not wise, but we can't take a call on when he needs fund or what he needs fund. And most importantly, stay away from market prices. It really, honestly, as investors, doesn't really make a difference to you unless you want to enter or exit.
But when you are giving so much importance to capital preservation, now this valuation is not sustainable for the next 5 years, and that on any valuation you can't justify this price. Then why would you hold it at this price?
Because I think the management, the criteria that you would practically look at still matches. I don't think, there's no set rule that if you won't buy it means you have to sell it. If I don't buy at this price, does that mean I won't sell it? No. Because every investment goes through every business goes through cycles. right? Until you see something, something going really wrong with the company, like they might not be able to get the growth, their products go awry, the management kind of has started, allocating capital very speculatively. You have no reason to actually exit a quality investment.
Maharaj, you have anything to add on this question?
From a behavior point of view, it would be endowment effect. Once you have something, you feel that that is much more valuable and the market is not paying the right price for it. So even if you have the data coming from the market, that is 50 times, 60 times, if you have something like this, you don't want to part with it. I think it would be more of sentimental thing, except if you have something great available. Otherwise, you have this sort of decision paralysis which happens. Well, you don't want to take a decision, forget it, so I'll keep it.
And the fact that he's buying more at 850 rupees and keeps on adding.
See, I tell you, that is too much of overconfidence and over-optimism in your first. It means like you are so much anchored to your first decision that you believe that you can just go on buying that it will just go on going up. I think that's not, that will be a job sort of thing.
The net is in number 7.
Yeah, that will be that.
And inevitably the markets have to prove you right.
And see, if you go to see in the market, this was when I entered the market, Tata Steel. There was this firm by the name of Hansal. They were the Reserve Bank of the stock market, one of the best broking firms. And its owner, Chandubhai, he believed that Tata Steel was a great stock. And he went on buying. His son was my friend, so we would be down over there, he'd tell buy. He never realized that when we were buying the stock, it was at his father's expense, because his father was buying all the stocks in the market. The problem happened was, then whom did he go to sell? Same thing happened with Sukti Jamna when he was buying ACC. So this is ultimately, these people become irrational over a period of time, because first is they are doing value investing. Okay, this is a damn good stock. Afterwards, then the ego starts developing. I want to be the winner. I am the number one. And when they start doing that, that is the sign of a downfall.
We don't discuss the ideas not because they don't want others to know about it, because they don't want others' opinions on it, because sometimes they themselves get confused with varied opinions.
So, it's a valid point, but what I'll also tell you is that at some point, these are the people who actually don't really care about the market. Number one. Number two, from what from what a little experience I have and what my mentor actually keeps telling me, is that you never ignore the voice of the market. The market is actually an ecosystem. Okay, you have traders, you have punters, you have arbitragers, you have speculators, people who don't know what they're doing. But together it is the greater concept of a market. So you don't ever ignore the voices on the market, because they can sometimes clue you into very critical things. And where I essentially agree with that point, like I said, today George Soros, for example, he builds positions of 2:1 leverage. So if he has $1 in his bank, he's actually building a position of $3. Now, I don't know where this is quoted honestly. The source of this again is this friend of mine, my mentor. He told me that there was a particular case where there were two traders, who had contradicting positions, and they carried that position for a sizable enough time. And at one point in the market, they knew that either one of them had to break. Now, mentally, what happened was one of the traders, who was actually long, that particular, let's call it a currency, who was long that currency pair, panicked so much that उसने सामने से फोन करके दूसरे वाले को बोला, क्या चल रहा है? What is your view on the markets? And in talking so, he leaked out his quote unquote, like his position. What that other guy did was, he knew that both of them were sitting in the United States. He took his position, started from Japan, started shorting that position till the point where when American markets opened, this guy was already bankrupt. So, in the trading point of view, I agree that you should not open your positions. But in investing, essentially, I disagree. As far as Warren Buffett goes, he says that when I started investing, I did not care about meeting my investors, and people literally used to come to his office and would want to kind of question him as to what stocks you're buying, he would very rudely tell them that my job is to talk to you only once a year and I will do that diligently. It is only after the introduction of Charlie Munger and their partnership that Buffett actually started talking to people. So his alter ego Charlie Munger essentially gave a lot of touches to Warren Buffett, and one of them was this, that you should actually not just like very closely hold your position, because sometimes the market can tell you more than what you might know. So I mean, I'm willing to kind of look that into detail, but that's what my sense and the book tells me.
There is a commitment and consistency bias. So once your idea is in the market and you have talked about it, then it's pretty difficult to correct if there is some mistake, and it is pretty difficult to fall back. So that may also be one of the reasons.
Yeah, I agree with you. And one of George Soros's risk measures is called beating a hasty retreat. The minute he finds out that his trade was wrong, he will not wait for his price to come back or someone to actually rationalize to him. He will just go and cut that position, and that is his margin of safety. If you were to understand. Sorry, you want to say?
Sorry, I want to understand that when you say don't diversify, because I mean the example you gave of Bill Gates and someone in the opera is perfect.
Sure.
But when you're looking at someone who's starting out afresh,
Absolutely.
I mean the only reason I would look at diversifying even a little, maybe into something I don't know at all, is because a certain amount of money that I want to hold so that I can reinvest in something I'm going to make money on. But just to ensure I don't lose, is diversifying wrong to start with? Or should I just go spot on one thing and maybe go bust?
Point number one, we belong to the same ecosystem. I'm not an authority. I can only give you what I think. Point number two, there are many maxims in the market, sometimes contrary, but there are. And one of them says that when there is nothing to do nothing. It's not wrong to be in cash. But the problem is to do something that you either don't or half understand, and just for the sake of being in equity, go into equity, you're taking on a lot of risks, my friend. Frankly, you don't know what the company does sometimes. Even if you know what they do, you don't know about the structure of the company, the business model of the company. You have no idea what are the litigations against them. It's almost like going out and someone selling you a flat and boss says sasta hai tum le lo. Go and buy it. I mean, aren't you going to go and do your due diligence?
For sure.
Very honestly.
For sure.
Now, this is actually the only market which I've seen where the more expensive something gets, the more equal you got to buy. Why is that so? It's because of all these things that are in the head. We essentially as investors need to make sure that we understand that when we're buying, we're not buying stock. We're actually buying a business. Right? And that business we're buying so it is profitable to us. How would you invest in a business? Or how would you even start a business if you don't know what you're doing? Diversifying on the other hand, yeah, it's all great. But at the end of the day, let's say that if I take $100 and I diversify into 10 companies, and you actually get 3 phenomenal picks, which actually double in their value. How much has your portfolio actually gone up?
No, I agree. It might not go up at all, but what I'm worried about is not going down. So when I get those 3 excellent picks, I know I'm going to remain at 100. I know it's a bad risk taker and it's a bad investor. But all I'm worried about is staying at 100 a day, and so the day I know that, okay, I have one more good pick tomorrow, I can make that 100 200. I don't have 80 to make 160.
So tell me, what's wrong with tax-free bonds and why are not? I mean, just go sit there in tax-free bonds. But what I'm trying to tell you is that don't seek comfort behind diversification, because it is essentially a weakness that you need to correct, boss. Go in there.
You can only reduce the risk by knowledge and not by diversity.
Absolutely.
That's what he's saying.
Absolutely. So the only insurance against risk is knowledge. No more, and that will take. Anyways, I think we're like way short of time. Thank you. Thank you so much. Just make a note that serious gratitude to Neil and Parag Bhai that they actually made it here, because we were speaking when sadly, unfortunately, Parag Bhai lost his mom this morning. So, I mean,
The show must go on.
our condolences, and I'm very grateful.
Thank you. Thank you, Richard. Thank you, Hansal. Now, please, can we break up for our dinner? Thank you very much, everyone.
You got to remember the law of the farm. You cannot sow something today and reap tomorrow. A seed has to go through various seasons before it turns into a fully blown tree. So is the case with investments.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.